I think just about everyone is here at the moment. Going to jump straight into this now. We're going to be running a Q&A session at the end, so please do add your questions into the chat as we go. We will keep the webinar to a maximum of an hour and a half. So any questions that haven't been answered at that point, we will get back to you after the webinar. So, and the very best way, let me just add, the very best way to get value from these webinars is to ask questions. So please feel free to add them to the chat, and it would be really helpful if you could just help me and state if your question is for Dale or Matt going forward. So welcome everyone to the first Fabric Invest webinar of 2021, and thank you to each and every one of you for joining us tonight. It really is much appreciated. So we'll be running these webinars regularly with a minimum of one a month, and generally towards the end of each month. But you will get notified well in advance by email, so please do keep an eye out for your emails, and obviously your junk, just in case it goes in there too. So the topic for tonight's webinar, as you can see, is Property Investor Insights 2021. And the discussion will be about the most resilient asset class that's shown itself during the pandemic and how you can invest in property in 2021. We shall be going through market updates and things you need to be aware of when looking to invest, which may not have been on your radar before this evening. So for those of you who don't know me, my name is Lynn Whittingham, and I'm delighted to be asked here again to host the webinars for the Fabric Property Group. For everyone who stays to the end of the webinar, we're giving away a free gift. So please do stop until the end for the opportunity to claim this, something I know that you will not want to miss, that's for sure. So without further ado, it gives me huge pleasure to introduce to you today from Fabric Invest, the Managing Director, Mr. Dale Anderson, and from Fabric Property Group, the Group Director, Mr. Matt Harper-Penman. That was a slip there. Shall I start again? Mr. Matt Harper-Penman. It is a mouthful. So there's no doubt that we're certainly going to be given some extreme value from both of these two gentlemen this evening, that's for sure. So firstly, let's take a look at Dale. Dale has over 15 years of experience in the property investment industry and is a hugely trusted figure and well known for his honesty, integrity and professionalism. Dale has previously led and managed a team that sold 5,000 units and raised over £1 billion. Dale has experienced both the positive and the negative sides to property investment, and certainly remembers the last property crash and how investors benefited from that. Dale's expert insights into the property investment market mean he's often featured in the media as well as property news and magazines. Dale has also been interviewed by The Times, the BBC and the Daily Telegraph. Matt is one of the co-founders of the Fabric Property Group. Matt began his career in one of the top UK accounting firms, Grant Thornton, and Matt brings both his financial experience and understanding for macroeconomics into the property world. Matt has raised many multi-millions of pounds worth in property finance, both privately and through main senior debt lenders. Having almost 10 years experience, a portfolio of 50 properties and involved in over 1,000 completed transactions, Matt's technical knowledge within property is absolutely second to none. So Dale and Matt also lead a team of 10 highly experienced property consultants at Fabric who are here to support you. Welcome, Dale and Matt. So guys, I'm really looking forward to this, as you know, always a great wealth of knowledge that you give us all. I'm going to hand over to you now, Dale, to get things rolling.
Thank you very much, Lynn. Very complimentary welcome as usual. So so guys, we just really, our company, what we want to really do with investors before we even look at projects or properties for sale is educate you and help you fully understand the UK market, what's currently going on, how is it being affected by Brexit and COVID, and also demand supply. So for me, I've always been into research, as the guys knows. I'm very much thorough on keeping up to date with market news, whether that's the latest reports from Savills, JLL, Knight Frank, Zoopla. I'm continuously studying the market and trying to identify areas where there's good rental demand, but also a lack of supply of good quality accommodation. Because let's face it, the fundamentals of investment is demand and supply. So for the UK, what really has always attracted me to it, and the reason I've invested in various assets, commodity stocks and shares. What I like about property in the UK, whether there's recession or economic downturn, there's always going to be that demand and supply imbalance. In fact, the UK government's target is 300,000 homes a year to be built. Last year alone, they only built 151,000 homes. And the reason for this is primarily there's been a lot of red tape around planning permission with developers. They are relaxing some of these laws now, in particular with commercial to residential conversion, which is great news for the market. Obviously, they've now extended the stamp duty holiday, which is again great news for the market. But what we do need to be cautious of is where the market's heading. And I guess that's what a lot of people are doing. They're sitting at home, scratching their heads, thinking, is it a good time to buy now? Can I capitalize on the current health crisis, or should I wait off for a few months or a few years? So in terms of the latest reports, we've done a lot of research. The latest Zoopla housing report actually contradicting what they said earlier last year. Savills said the prices were going to drop by 5 to 10%. House prices actually went up 4%. This has largely been down to demand for houses remaining quite strong throughout that time last year, but also change in buyer patterns. Investors' demands have changed. A lot of landlords are looking for properties in more tertiary locations outside of the main city centres. And what's also fueled that is basically there's been an increase in activity amongst first-time buyers, along with a squeeze by a lack of mortgage availability last year. So what's actually driving the shortage even further, Brexit and COVID has actually created a further shortage because less big developers are coming to the market with new schemes due to uncertainty, and less sellers are coming to the market because they think, well, hang on, I'm not in a position to sell now. There's a lockdown. Estate agents can't do viewings like they could before. So we're actually finding a bit of imbalance. In fact, the only area where we are seeing a downturn in prices potentially is London. London's obviously been highly inflated for many years. It is the global trading center, and it's been a great property market long term. But because the prices are so high and yields are low, along with the supply levels on the market and shortening of demand, we're finding prime city centres like London and Manchester city centre slowing down slightly, and then other areas outside commuter belt London have increased. But what's really sort of, and this is something I've been saying for a couple of years now, is the top of the list has been Liverpool and Manchester. So Liverpool and Manchester are leading the way. Liverpool is first at the moment at 6.3%, and Manchester coming in at second at 6% last year. So the Zoopla price forecast UK average 4% growth last year. And again, they actually saying that the demand is still there. Investors are benefiting from the stamp duty, but there's actually a shortage of accommodation coming to the market. So there's still a demand for housing, but we do need to obviously tread with caution and sort of look at what's going to happen over the next few months, and perhaps not always focus on maybe like the bigger cities and start to look at different areas like Preston, Leeds, Sheffield. So that's where the market is at this stage. This is the Zoopla housing map on the right. We've got these marketing reports available, but really just to sum it up, there's an imbalance of supply to meet demand and the growing population. And if you look at property prices since 1955 up to 2020, the UK market has, even through recessions, which we're not actually in now, we're in a bit of a health crisis, although it is putting a negative effect on the economy and GVA and output. There's no doubt about it. But the fact of the matter is there's a less of a supply in the markets. There's a rise in rental demand because of generation rent. So the UK has a huge retention of a young population working in the city. So these are my thoughts. I think there needs to be more housing built. Rental growth is due to rise, according to JLL, in the next 5 years by 17%. And young people are now half as likely to own homes than previous generations. So there's clearly still a housing crisis. We've got one of the best education systems in the world. Lots of students still coming to the UK. COVID, in my mind, I like to be an optimist. The vaccine's been rolled out. It's a temporary issue. It's not going to be around forever. So I think while landlord behavior's changed at the moment, thinking, oh, maybe I should buy in rural areas, when there is a recession, cities have always been one of the safest investments. So that's my thoughts. Matt, I don't know if you've got any extra thoughts to add to that. But yeah, we can talk about this for a very long time, and that's just to summarize our thoughts at the moment.
Yeah, absolutely, mate. Completely concur with what you've just said there. The UK market is one where there's finite amount of land, and actually the amount of houses being built is not keeping up with the population growth. Science is advancing at such a velocity of speed right now that we're living longer. We're sort of, I guess, outliving the accommodation. So it's a good thing for us as investors, because when there's actually more demand than there is supply, of course prices will go up, and I think that's reflected in these reports here. So yes, that's what my thing would be to add to that.
The only exception really has been London. So London demand levels have fallen year on year. Obviously, there's a caveat. Demand levels in London, they might be down 17% compared to last year, but levels, there has been still activity due to the stamp duty. But I do think investors are looking at other areas. The fact is there's 13% less number of homes available for sale versus a year ago. So less homes and continued demand, whether that's due to the stamp duty or the UK still being deemed as a safe haven for UK and overseas investors. There's various factors to consider. Naturally, we do need to be cautious of, harped inflation in certain areas due to stamp duty and, other factors. But I think it is good news that the stamp duty has been extended. It should help stimulate growth. I also think a lot of landlord savvy investors are capitalizing on the current low borrowing rates. Banks, bonds and shares are not doing too much for us. So if you want to carry on to the next slide, Matt, and then we'll discuss further the market forecast. So yeah, Manchester and Liverpool forecast seems to have the highest growth. Naturally, there's still things to consider, such as supply and demand and oversupply. And then we're also seeing some very good statistics in Yorkshire and the Humber at 24%. So this is based on the latest Savills residential report 2020. So again, it's been a lot more optimistic than we thought. In fact, I put it in our UK property guide at the beginning of last year. I actually said prices were going to drop 9%, and the market slightly contradicted the polls and what everybody's saying due to the factors I've mentioned. So Manchester and Liverpool, the forecast seems strong. They are saying it's going to be quite stagnant at 0% in 2021. But then sunny side up, hopefully the vaccine's rolled out, the lockdowns are over, 6% in 2022, followed by 2023, 8%, and 2024, 6.5%. Now, no one can really look into a crystal ball and guarantee these predictions, of course. This is just what the market's saying, according to JLL, Savills, Rightmove, and the Zoopla Housing Index. I'm also very passionate about the emerging commuter belts, and I do think a lot of the attention is going to move away from the likes of certain major cities and capital cities, more towards commuter belt regions. I've been saying this for years about London, and I was right. I invested in some commuter belts, which have done extremely well for me, further outside of London. But areas like the Media City, which is sort of going to be like the Shoreditch the tech hub of Manchester, easy commute into the city centre, but prices £150 cheaper per square foot. So good infrastructure investment there. Preston, we really like Preston. It's been on my radar now for a couple of years, actually. I've been doing a lot of research and thinking, Preston, I don't know it that well. But once I actually got to study the city and what's going on, I think there's great potential. And then even places like Sheffield and Dudley, you know, we do believe there's good potential. So when you think Northwest, don't always just think, okay, Manchester, Liverpool, Leeds. Yes, there's some good investments. There's some potential investments that are not so good, but certainly the emerging commuter belts are an area that are of interest to me. And that's because of what Savills are projecting. I mean, there's been stronger than anticipated rebound, despite the weak economic backdrop. The evidence points to a modest growth in 2020, slightly stagnant growth this year, but I foresee this year as being a year to potentially capitalize on opportunities and low borrowing rates. And then naturally, you know, we do take an educated approach. So a lot of this of what we're telling you, we can send you the market research reports and go into more depth. But the outlook for the rest of the year, you know, we're not out of the woods yet. Obviously, there is going to be an economic impact. There probably is going to be, there already is unemployment. The furlough scheme has had to be extended. So there's a lot of factors to consider, including tax and various other factors. But all the indications say that there is going to be migration to these cities, and there's a lot of infrastructure and investment going on, such as the HS2. So over the next 4 or 5 years, if you're not speculating, there should be potential good gains to be made in some of these cities. Do you want to go to the next slide, please, Matt?
Brilliant.
So yeah, I'll pass it over to Matt now, and he'll run you guys through the impact of COVID-19. Thank you very much.
Lovely. Thanks, Dal. So no yes, evening all. It's Matt here. So it's interesting times we find ourselves in, and we have done for what is nearly 12 months now, which I think probably all of you agree who's on here tonight probably feels a lot longer than 12 months. But in terms of how that specifically impacted the property market, I think, you know, going back, say, to 12 months when we had that first lockdown, that's when we saw the biggest impact, essentially. You know, you're going to actually find that you know, there was a lot more uncertainty at that point. Not many people really knew what was going to be happening. So there was like lenders that were, you know, potentially pulling out of the market at that point. We had RIC surveyors having COVID clauses put into their, you know, into their valuations, that kind of thing. But now that we're much more mature in the cycle, and you know, there is light coming out the end of the tunnel, you know, with the vaccines like Dale's mentioned, and also there's been the announcement this week about the plan to come out of lockdown. I think, you know, everybody in the property space it has a much more predictable feel to how it is reacting. I mean, even to say a couple of months ago, RICS actually themselves, Royal Institute of Chartered Surveyors, actually removed the need for COVID clauses in the valuations, which is a massive positive, because I think you probably agree, RIC surveyors are probably some of the cautious people out there. So that's really a good sign that we're actually, you know, looking at, you know, into the future with a lot more certainty and confidence coming through. So that would be the COVID-19 aspect. Now we talk about Brexit. Again, very much echoing the same sort of sentiment, as you like, for the COVID-19, which is essentially we've got a lot more certainty with what's happening. You know, decisions have been made, albeit, you know, when Brexit was first announced, I think there was a lot of opportunity for overseas investors, and we certainly saw that being taken advantage of while the pound was weakening against external currencies. So, but now we've got much more certainty in that space as well. I think, you know, that's also looking a lot better for, you know, for the UK. But looking at the economy as a whole, I'm a massive macroeconomics, you know, passionate about it, and anyone who talks to me will probably get an earful from it, and you're going to get some this evening, hopefully educational and hopefully very helpful. But we're looking into a market now where we're in the record low borrowing rate. So to actually, you know, borrow capital is probably the lowest time it's ever had in history. And if anyone has been following the news in the last, say, 2 to 3 weeks, there's actually been an announcement by the Bank of England that are actually looking and putting banks on notice to be in negative interest rates in the next 6 months. Now, a lot of people may say, does that mean that we're going to be paid to have a mortgage? It's not quite as great as that, but it does mean that we're going to be paying the least amount of interest there probably has ever been in history in the UK. Some of the other countries in Europe are already in negative interest rates, so we're just following that trend there. So it again supports leveraging a portfolio and making your capital work as hard for you as well. And just touching upon the stamp duty extension, okay, it doesn't necessarily benefit investors with a second property as much as it would for a residential buyer, but what it does do is supports the property market in terms of the fact that we've got people moving, people are buying more, which has created a surge in prices in certain pockets, especially with people that are potentially buying property that maybe couldn't have afforded before if you included a stamp duty tax. So again, it's supporting growth, and that extension is going to be no doubt helpful for us going forward. So this is a topic that I am massively passionate about, and not many people actually understand it and grasp it, but it's very, very simple in terms of how I'm going to explain it to you. So this is what I call the invisible tax. And we talked about COVID-19 as potentially having an effect on the property market. And I talk to people every single day when I'm having consultations with them. And essentially, one of the biggest topics is COVID-19 as an impact on property. Now, arguably, this has much more damaging financial impact than COVID-19 has. I mean, Dale's even explained earlier the forecast from people like Savills who spend millions of pounds on their research. But this is the invisible tax, which is called quantitative easing. And if you don't know what that is, which some of you may already know, is essentially printing of currency. So the way to explain this is that before 1971, we was on a gold standard, okay? And that meant for every dollar in the world, there was gold that backed it. And when we got taken off that by Nixon, US president, essentially what that meant was governments around the world could print currency to an infinite amount of currency, which basically when you print currency, it devalues it. So if I can explain this to you very simply, if you can see my cursor here, we was at March 2020 when COVID-19 took, come to the UK, we was at a printed currency of 645 billion pounds in printed circulated currency. Then we had COVID-19, and everybody's familiar with furlough, with the bounce back loans, and that stimulus package was 250 billion pounds. So the Bank of England didn't just go and get that out of the vault and say, here you go, UK, here's a load of cash. They actually printed that cash, which if you and I did that, that would be called forgery. But when they do it, it's called quantitative easing. Now, what they're doing by actually increasing that supply is very simple to understand if you can grasp the simple principles of economics, which is essentially supply and demand. So as something grows up in supply, the value of it decreases. And the way to explain that very simply is if you had a Picasso painting, one of a kind painting in your hand, and then you placed a print painting from a supermarket that there's one of a million copies, the Picasso painting will be worth so much more because there's only one of them. Now, if you relate that concept to currency, you increase that supply of currency, then it's automatically going to be worth less. Now, what we did by having that increase in that stimulus was printed 250 billion pounds. And what that meant was we then increased our supply to 895 billion pounds in printed currency. And I'm going to explain to you just now exactly what the implications of that is. So that 250 billion increase represents a 38% increase in the GBP currency supply. So 250 billion is 38% of that 645 that was in existence before March last year. So to put that into perspective, £100,000 today over the course of time, so this is not going to be straight away, but over the course of time, it will lose its purchasing power by 38% by default of that economic principle. Now, don't get me wrong, that's not the only factor at play. There are other things that can affect this, but I'm just talking very simple concept here. Now, what will happen, and the reason why this is such a dangerous thing if you don't grasp it, is essentially it is invisible. that £100,000 in your bank account isn't all of a sudden going to be worth, going to stay in that bank account a lot less money. What it will do though is buy a lot less goods and services, because what will happen is goods and services will go up over time. Now, when you're looking at that, you might be thinking, well, that's a long time away. But actually, if you think about it, what I just touched on earlier was we've got the vaccine being rolled out. We've got the roadmap out of COVID, and this will happen as people get confidence in the market. Now, at the moment where you've got that uncertainty that's been there for the last 12 months, people aren't necessarily spending and buying that new TV or buying that holiday. What they're doing is they're probably holding on to that cash and thinking, I could lose my job here, so I might hold on and wait and see what happens. But as this relaxes and we go back to normal life, people will start to spend more, and that's when we'll see that rise. So it's very important to protect yourself against that, and you can do that through investing and keeping yourself, invested into the right asset classes. Now, having said that, I'm not saying invest all of your cash at all. I'm saying, invest the investable amount that you have. So what I mean by that is have a burn rate that you have in your account, which is your rainy day fund. So usually that's 6 to 12 months worth of living expenses that you have. And then everything on top of that should be investable capital allocated in the correct places to protect yourself. So if you're wondering how we actually work out that devaluation, the calculation is on the screen here in front of us. So £100,000 minus 38% would then mean that we can buy £62,000 worth of goods and services. Now, you might be sitting there thinking, well, Matt, how quickly is this going to happen? Now, it's a very hard thing to say that that's going to happen, but ultimately it will happen over a period of time. But it's very hard to say when that will happen. So if I'm in my shoes saying what I would do, I wouldn't let it have a chance of happening. I would move and protect myself against it. So we're going to talk about how we can protect ourselves against it, as we go through this webinar. So what does this actually mean relatable and it's sort of put into context? So that would essentially mean that, thing I just explained just there, that 38% decrease would mean that it would be like someone coming and knocking on your door and actually saying, can I have £106 off of you today, every single day for a year? And that would be £745 every week. And that would be £3,200 a month, which is actually more than the majority of people I speak to on a daily basis, monthly expenses. And that would then equal the £38,000 decrease that we was talking about in the previous slide. So again, like I say, it's just bringing it into context and actually saying, let's protect ourselves against this. And that is it is really important to note. Okay. So we talked about that, and that's a really important thing that we need to protect ourselves against. But there's really three main reasons why people will look at investing in property, and that is actually to do with nothing to do with property. I mean, some of us in this room may have a massive passion for property, and anyone that knows me and Dow, we can talk until the cows come home about property because we're massively passionate about it. And, I think to the detriment of our other halves will probably, snigger and if they're watching as well. But yeah, this is something that we're massively passionate about and can talk about it. But most people, this is a vehicle to get to the best life that they want to live. And usually those three areas of their life to improve is financial independence and wealth protection, retirement plan, and spending time with the people you love. Now, Dow absolutely hit the nail on the head earlier when he said that we take a very much consultative approach to this. And whenever we speak to, our clients and people that we were talking to, we want to know about these three areas of their life because, essentially this is what we're trying to help achieve and get better at. But the key thing I will say here is that we haven't got time to go into all of this evening, but we'll talk about a way that we can be looking at this and helping with you as we move forward and help improve the areas of your life as well. Okay, so we talk about property as an investment. Now, let's just pose the question, where else could you actually invest and where could you go? So you've got the stock market, let's say. Now, yeah, okay, you can make money in stocks, and I'm not saying that you can't, but I think a very poignant and very recent example of why I don't invest in the stock market is because if you've looked out there and you read the news, you've got the GameStop saga, which happened. And essentially that was a clear manipulation of the market, probably the biggest one that's probably ever been. And if you didn't see it, I'll just explain it to you very briefly now. So basically what happened was there was a community called Reddit, which is a forum for investors where they talk about different ideas, investment ideas, etc. And what they realized was there was a stock called GameStop, and you can have a little research of this after the video, and there's lots of stuff out there on it, essentially that was being shorted by some massive hedge funds and really pushed down to an artificial low. And what happened with these retail traders and investors on this forum is they got together and actually beat the hedge funds and actually bought the hedge funds and pushed them up to a point where they was at breaking point and lost billions of pounds. And actually, you know, nearly, I think one of the hedge funds had to get bailed out. Now, when that happened, the actual trading platforms restricted the amount of buying power that the retail investor could have. And what that did was allowed the hedge funds to get back on top and win again. So really, to understand that in layman's terms, what I'm saying is that when David started to beat Goliath, the rules of the game were changed on him, and essentially so that Goliath could win again. So there's a lot of this out there. You can go and have a look at this for yourself, like I mentioned. But you know, I don't want to be in a game where the playing field is not fair, you know, and where there could be rule changes mid-flow. So that's something that I would be massively aware of. Like I said, though, you can make money in the stock market, and I'm not saying that you can't, but again, why would you put yourself in a position of risk when you don't have to? So moving on, so we've looked at stocks. Now let's look at crypto. Crypto is, you know, is a hot buzzword out there. It's not been around as long, and potentially, you know, probably I'd say in the mainstream media, one of the most exciting investments right now, because of the amount of growth it's having. It's unprecedented and amazing, really, what's happening there. So there is 100% some really good growth that could be shown in the crypto space, but it comes with a lot of volatility. So if you're invested in crypto, I think you just need to have, you know, big enough balls, if I can say that, to be able to ride that wave, and make sure that you're, you know, the amount you've got invested there could go to zero. It's not got a massive history in terms of its existence, but like I say, it does have the potential to have, you know, explosive growth. So, you know, it's a place where you could invest, but it's not stable. It's not a stable investment. You know, I think just before Christmas we saw, you know, and a lot of the market cap fall out the market. So again, just something that I would be saying to you to be aware of. Now, commodities such as gold and silver, you know, it's something that actually I invest into. I don't have a lot in my portfolio, but it's a very good store of value. It's got a 5,000-year track record, and it's something that, you know, I do invest in, but a very small part of my portfolio. But the reason why I don't have a lot of it is because it doesn't provide a yield. It's a hedge. It's not a cash flowing investment. And then we look at bonds. Bonds are, you know, are massively underperforming at the moment when you look at other investment classes. So that then brings me to property. We've looked at those other 4 investment classes just there. You're looking at property. It's got a solid track record. It's got consistent track record data of growth in terms of over time. Yes, okay, there's cycles of corrections which are healthy, but it has always increased in price, and it has always produced a rental cash flow. And one thing that UK property has over all of the other you know, asset classes is that it's what I would call a true commodity. And what I mean by that is that it's every single one of us on this planet needs a roof over our head. So that there lies in a factor that there's always going to be a demand for it. No matter what happens to currencies around the world, whether they, you know, go down or go up, there is going to be a tradable value for a property. So, you know, owning properties is such a good thing, and that's why I'm heavily invested into it. That's why I'm massively passionate about talking about it, and I'm excited to talk to you guys about it too. So the reason why we've actually seen overseas investors buying into the UK is because of these currency advantages that we've been seeing. So the UK pound has weakened, due to COVID and due to Brexit, like we've seen, and like I explained earlier. So we've seen massive rushes from expats into the UK. And also, and like Dale probably will touch on, he's had a lot of experience with overseas. We've got places where there's actually political unrest and instability, basically like places like Hong Kong with the B&O visas coming over, and also, where Dale is actually based in South Africa, which I'll let him have a little comment on as well in just a moment. And the way that these overseas investors have been benefiting from the UK system is actually by buying through UK limited companies, which some of you already on this webinar will probably be very familiar with. But essentially, buying through a limited company in the UK almost allows you to act as a UK person. Okay, be it you may have extra interest rates to pay, which we'll probably go through in the Q&A section, but it allows you to build that track record for you here as a UK person. So, Dal, do you want to add anything quickly to the overseas bit?
Yeah, thanks, Matt. That's really interesting. So I spoke to Matt about quantitative easing a few weeks back, and he just went on like this research mission, and like the value that he's adding to me, like I'm even thinking now, like, it's really got me thinking. So that's great. So in terms of overseas buyers, I've been all over. Like I've frequently gone to Hong Kong, Singapore and South Africa, as well as the Middle East, and done some shows and events, when the world was normal, and we got on a stage and spoke. So basically, what it is South Africa is interesting because you do have pockets of wealth and people looking to get money out of the country simply because of government corruption, devaluing of the rand. So people are looking again to safeguard for their retirement, for their children, by offshoring their investments into strong, stable currencies. And irrespective of Brexit and COVID, the UK currency is still, it's considered one of the safest, along with places like Australia and New Zealand, as well as Canada. So from that perspective, people from South Africa, I've got lots of clients very much interested in the UK. They also got children studying in the UK and planning to migrate and immigrate because of historical ties to the UK. So that's one factor. Hong Kong naturally was taken over in the 90s, as you know. It was a British territory. I've got a lot of friends in Hong Kong, and they have their concerns over the rule of law coming in and certain things changing with regards to political stability and human rights. So, for them, the UK is great. They know it well. They often have friends or family living there as well. Also links with the British National Overseas Passport. So we have seen a huge demand in particular places like Manchester City Centre. You can see a lot of tower blocks coming up there, and it's starting to almost get feeling like Hong Kong. So that's the thing. I mean, you've got all these other places in the world. They've got their own problems, and they're looking for also areas for secure investments. So a lot of direct foreign investment is coming in from South Africa, Hong Kong, as well as Singapore, Middle East as well. We get a lot of good clients from there because they are also exploring ways to offshore funds, and they've got children studying in the UK. We've got such a great education system there, so they have the links and the ties. They enjoy visiting the country, and even if the pound's down at the moment, it actually benefits them because they get cheaper holidays and whatnot post COVID. So that's my thoughts on that. In terms of overseas investors, I'd say 60% of our customers are UK based, and the other 40% are overseas. In particular, we've got consultants, like Shaz, who are specifically focused on the Middle East. That's an area he's got family ties from the Middle East, so he understands the laws and the regulations and the concerns and Sharia law. So people like him we have on our panel to assist with the Middle East investors. So thanks, Matt. Brilliant.
I think you're up next now, so I'll move on to the next slide.
Yeah, great. Yeah, so this is an interesting subject, the Great Northwest Divide. London's always been a great place to invest. economic hub. You know, people have, let's face it, I mean, some people have made over 400% return in London over the last 10, 15 years. So it's been a great place, but definitely we're seeing a change in landlord behavior. There's actually been a 31% decline in investments into prime London property. You know, there are still a lot of overseas investors that want those prized properties in London, and I do believe London is always going to be extremely resilient. Why? Because population, right?
Dale, you've just become muted.
So all of a sudden, London's not as attractive as it was before. And we are seeing a migration of investors. There's been an increase of 34% investments into the north, west, and Midlands and Yorkshire because of the yields. So cheaper prices. You know, the average price of property is a lot cheaper. I guess it's also the stamp duty increase. There's been a 3% surcharge in the stamp duty. I know that they're debating it now and things might change, but that's all of a sudden made London very expensive. So it feels almost like the prices have peaked a little bit. Commuter belt London, yes, there's some good opportunities in perhaps Kent, you know, places like Milton Keynes, perhaps there's some good deals, but we're seeing demand increase. And I think a lot of that is down to the Northern Powerhouse Initiative. There's been a lot of government investment into infrastructure programs. The HS2 is now on with, so that should be cutting commuter belt time down to places like Birmingham and Manchester by half, you know, 1 hour. So a lot of investment going in there. When we talk about Manchester in particular, there's been a huge amount of investment into Manchester as the second fastest growing economy outside of London. You know, things like the Media City, the Peel Group have invested massive amounts, billions of pounds, and you can see that there's the skyline changing every year. It's just changed so much. So there's definitely higher demand because of the more affordable prices, and also because these cities have their own economies. But I think as well, London has become so expensive for the growing young population that the young demographic are thinking, well, hang on, especially with COVID, right? People's perceptions have changed. I don't need the expensive office in central London anymore. I can set up my business for half the price in Manchester or Liverpool. You know, the cost is going to be a lot less. So we're seeing an exodus of the sort of generation rent, 25 to 35-year-olds, and there's been a huge shift, and about 30% of Londoners, in fact, are now investing outside of London, you know, rather than in London. So they've built up all this capital and equity in their properties in London, and they're thinking, well, hang on, my yields now not great. I can release this equity, and I could potentially expand my portfolio by investing in these more affordable cities, where there's all this regeneration going on. Plus, I can get a better yield of 5 or 6 or 7% in some cases. So yeah, so that's my thoughts. So, do you have any thoughts on that, Matt, at all?
I think you covered it there, mate, to be honest. But yeah, no, you did. You touched on the bits there. But yeah, no, we're seeing obviously the northwest is leading the way for sure. The northwest powerhouse, like you touched on, and the transport links coming into London, mate. Yeah, I think we're going to see some good growth in those areas. Excellent.
And I know you touched on a lot of landlord behaviour has changed with regards to now people are thinking, well, rural areas are great, right? So I'm getting a lot of investors. In fact, a client recently asked me, because he goes on some of these wealth courses that you've got to pay for and stuff like that. And basically what they're saying is buy distressed assets in more rural areas like Wales. And I'm thinking, well, hang on, that's all good. But then I spoke to you, Matt, because you've got experience in both, right? Distressed assets, HMO. So what are your thoughts on that?
Great question. Right. So I'm a massive advocate of having a balanced portfolio. One thing that I see all too much, and I was actually one of these people that went on courses, you know, went and done these distressed assets, but actually built my portfolio incorrectly and put myself too much at risk. Don't get me wrong, I'm not saying you should have all of one strategy and all of another. And this is something we go through in the consultation. We talk about this, but essentially the safest areas are for investment to start your portfolio is essentially city centres. And I'll just explain that very, very quickly. So thanks for letting me talk about this, Dal. Is essentially the reason why city centres are the safest place for you to start investing in your portfolio is very simply the macroeconomics behind it. Again, like I said earlier, I'm a massive macroeconomic buff, and it really can give you predictability for behaviour and migration patterns, essentially. So let's just go through it. So essentially, the reason why it's a very good thing to start there is because in a city centre, what you have is you have lots of work. So when you have lots of work, you have a population growth because people are drawn to that area like a magnet because they need an income. So they need to go where the work is. And when you have that, what happens is you have a population growth because of that factor. And when that happens, you have people buying more property, which basically pushes the price up. So that's a very good thing for capital growth. But of course, you will get better, good yield as well. But you're not necessarily buying for yield in a city centre. You're buying for safety. Remember that. That's a very important factor. We can layer some stronger yield in later, but the key thing is safety. And that's not the reason why it protects you. It's a very good fundamental, but it's not the reason why it protects you. This is where the gold lies. And this is what so many people miss, even myself when I first started out 10 years ago. And this is this factor, right? So when you have a rural area, what you have is you have mum and pup businesses. So you've got local eateries, you've got independent shops, and everybody on this webinar tonight can probably think of some of these types of businesses. And what you'll find is that in a market downturn, these businesses will not cope very well at all. And unfortunately, in them businesses, there'll be a massacre. There'll be businesses that will go under. And the reason for that is because they don't have very good balance sheets and they don't have very robust cash flows. So the reason why that they will go under is because of that simple fact. So what happens there, the people that are employed by those companies all of a sudden become unemployed. And then, so unemployment goes up. So what happens then is less people are buying property. So the prices decrease and you can very quickly find yourself in a negative equity position, which is not a great thing. The bank could be calling for that back. And I've seen it happen to so many people, even friends of mine that have overexposed themselves and got themselves into that difficult, sticky situation. Luckily, I managed to maneuver and pivot and add some safety to it. And I'm going to explain the safety element to it now. So you've got them rural areas and they're the risk, the mum and pop businesses, weak cash flows, weak balance sheets. Look at a city centre. Now, of course, the market is going to shake. There's no hiding from that. However, what you will see is there'll be maybe a couple of casualties and there'll be a minority amount of casualties than there would be to the ones that stay because they have bigger balance sheets, more robust cash flows and have been around longer. So they're able to weather those storms, which then means that the tenants that actually work for those businesses stay employed. And ultimately what that means for me and you is that they can pay their rent and stay in the property. So the economy survives a lot better within a city centre area than it would do in a rural area. So that's my take on why you should be looking at that first.
Okay, great. And then also, guys, like I said earlier, Manchester city centre and Liverpool, we're not saying invest there. There potentially is, and I've said this, I've been saying it frequently recently, city centres, probably there's a bit of an oversupply. So what we're saying is look further out. There's places outside of Manchester, more sort of along the Stretford area where there's more regeneration going there, because let's face it, it's all about affordability. So that's why we're saying Preston, that's why we're saying Sheffield. We're not saying look at these areas in particular, but we just look at the factors based on market research and what the experts are saying, medium to long term. Yeah, maybe not overnight, but there's sustainability in terms of population growth in certain areas. So, yeah, that's it. So you need to take a measured approach. There are certain cities and areas where I believe, in particular, like Manchester city centre, I'd look at the commuter belt areas which are more affordable for renters in the short term. So like I said, we look at a sort of a very balanced approach, and that's why there's other cities that we think could be definitely worth looking at in the future. But yeah, if we want to move on to the next slide. So spotlight on Manchester, according to, naturally, as we mentioned before, according to Savills and a number of economists, and what we're looking at in terms of projections, they're saying 27% potential growth over the next 5 years. Whether that's accurate or not, we're not sure. We can't predict the future. But in terms of JLL's forecast and Savills, that's their market indication. Manchester's forecast to see both the high sales price and rental growth. Again, not city centre. We're looking at sort of overall Greater Manchester, partly because of the Peel Group. There has been a large urban regeneration effect, especially in the media city, the home of the BBC. And yeah, so we do feel that Manchester's housing market, whilst there continues to be a supply, there's no evidence that there's a slowdown. In fact, the local economy and the population are growing. So there does seem to be a good retention rate of young professionals, and also migration and growing population of people coming into the city, moving out of London, looking for places up north where they can rent cheaper, where they can run their businesses cheaper, and which have good regeneration in the surrounding area, as well as the lifestyle aspect. You know, Manchester and these types of cities, there does seem to be a lot of business startups, tech companies, and business professionals. So, as I said, you know, these are stats that we take from Savills, JLL, and various market experts, but there are other areas we believe that you should be also looking at. Don't just sort of go where everyone else is going, Manchester, and take a measured approach and decide what's going to work best for you. Manchester has an excellently sort of good retention rate on students, 100,000 students. That's been changed due to COVID, more online studies. But again, once that's over, you've got Salford University, you've got Manchester University, so there is a large student population. It's been a very buoyant market the last 5 years. It'll be interesting to see what does happen over the next 5 years, but in terms of economic strength to date, it's coming in second just after London, and third coming in Bristol. So the underpinning principles, it's a robust city. The GVA is growing at the second fastest rate in England. And if we look at the demographics, you've got 2.35 million people. It's now that was in 2000. The population now stands at 2.73 million. So there is a growing population in Manchester, but we do think that people might start looking a little bit further outside of Manchester into some of the more tertiary locations. So if you want to move on to the next slide, please, Matt. Liverpool, again, a city I've been very passionate about. You know, they are looking to be offer more sustainable new builds. We do pre-qualify all our developers. We have a very stringent due diligence process, tax professionals, legal advisors who look at each scheme just to make sure that they are secured. In terms of Liverpool's housing market, average two-bedroom flat is now going for £195,000. Your average two-bedroom rent is £1,000. So again, it may not be the case that people are rushing there for price appreciation. It may be a case that there might be a mild oversupply in the foreseeable future. But what there is good yields and affordable prices. So anyone looking for passive income, it was the highest performing city and has been the highest performing city for rental yields. It's in particular L1, because I think as a city centre, there's still a lot of potential in Liverpool. And although there has been some developers who've perhaps not delivered, I think now they are going to clean up the city. There will be more sustainable opportunities moving forward, and better regulated new build schemes. So schemes we work on, you can see the progress, steel frames out the ground. You know, we often make sure that all the planning permission, environmental checks and everything else are done. And again, if you're looking for yield, Liverpool is certainly one that seems to be on the map. But JLL expect 14.8% increase in rental growth in the next 5 years. So rental growth seems quite solid. The Peel Group, again, that Liverpool Water Visions has started. You've got developers such as Romal Capital and various other developers. There's a scheme we're working there with one of our trusted developers, a guy named Damien Baker, and he's delivering a really neat scheme of 85 boutique one-bed apartments in the city centre. What's driving the rental demand? You've got business demand, professionals, you've got university students, you have the Royal University Hospital, the new hospital, and you've also got tourism. Liverpool globally has been popular with overseas tourists because of the Beatles and the football. So that's what's driving the rental yields, whether you're looking at a long-term strategy or a short-term strategy, there is good potential yields to be made, along with the 14 billion regeneration underway on the Liverpool docks and the Liverpool water vision. So stronger regulations definitely needed, more sustainable new builds that factor in environmental impacts and security on investor funds, and also ensuring that there's funding in place with those developments. So lots going on in Liverpool. We do believe it's certainly holding its value. Whether the prices will go up and down or whether there's going to be a oversupply, time will tell. But what we do know is there's a lot of regeneration going on, and as a population, it's grown from 889,000 to about 902,000 in 2020. So again, where we tend to focus our sites on, we have a development, as I mentioned, which is close to the Upper Central mixed-use scheme. It's a £2 billion scheme underway, which will create 7,000 jobs in the city and 2.5 million square foot space, including offices, restaurants, shops, and gyms. And then the Liverpool water visions, there's no more space in the city centre really to develop, so it looks like they're going up north on the Princess Docks. So you'll start to see a lot of construction activity on that side of the docks over the next few years. You've got 5.5 billion of investments on the waterfront. It's better value than the average major cities, so prices are still quite low, and it's also seeing the highest number of business formations, creating thousands of jobs. So if you want to go to the next slide. So this is one that's really exciting me, is Preston. It's one of the sleeping giants of the Northwest. There's a lot of economic development going on there. They've got the what's called the Stonygate Master Plan, which is going to be a £450 million cash injection into the infrastructure, retail, commercial. So yeah, a lot of regeneration going on. Nice city with good outdoor space, parks, good infrastructure, and really as an economic travel hub, it's going to benefit from the HS2. So the local economy is projected to grow by £1 billion. You can still pick up a decent sort of, we've got a development there with one of our very good developer partners, Heaton Group. They've got a great track record, and you can buy in at about 120 to 125,000 pounds for a one bed and secure a realistic yield of between 5 and 6% net. So again, according to the experts, they project 27% over the next 4 or 5 years, and they're going to benefit from the transport hub. Rents have increased last year. We work with the likes of the Heaton Group. Matt Eastham is very well known in Preston, and he speaks very positively. Again, just keep an eye out for developers who are maybe offering long-term rental guarantees that are unsustainable. So what we like to do is look at the demand and supply, get the rental valuations done, and tell exactly what you're going to get after all your costs. But definitely a rapidly growing population. In fact, 36% of Preston's population are under the age of 21. So as a city, it's really leveling up. And, while Manchester and Liverpool's definitely been on the map for a while now, I quite like Preston. I think that the two cities are seeing a bit of a ripple effect across the region, and areas such as Preston, it's worth shopping around in different locations for potentially better value deals, lower prices, and better yields. Again, education's been at the key in the heart of Preston. You've got the UCLAN plan, which is a £200 million master plan for the expansion of the university to a new modern creative hub with cutting edge technology. And transport, as a transport hub, easily accessible to, you've got the M6, M61, M65. It's opening up travel throughout the UK for residents and those looking to do business. On the West Coast main line, so easy reach to Lake District, Edinburgh, Leeds, Peak District, Manchester, Liverpool, and London, all within very easy reach. 38-minute drive to Manchester, 1 hour to Liverpool, 50 minutes to Leeds, and 46 minutes to the Lake District. It's one of my favorite places in the UK to visit with the family. Manchester by train, 40 minutes, Liverpool, 50 minutes, Birmingham, hour 35. So great transport, and definitely the economic centre for Lancashire, which we believe is going to benefit from a huge amount of regeneration going on including the Stonygate master plan. So if you Google that, you'll see what the 10-year plan is all about, which will create a vibrant mixed-use urban village in the city centre. And as I said, we tend to look at developers and developments which are close to the regeneration in these city centres. So investors can now buy in sort of at the good prices, and hopefully in the next 5-6 years look back and say, well, you know, that was a good, wise decision that we made there. So yeah, lots going on, big regeneration in Preston. I won't go on. You can obviously, we can provide you with any marketing material or market research. So yeah, so anything in particular you want to talk about, let us know. When we talk about student property as well, you know, the market, I'll be honest, PBSA itself right now has taken a knock in terms of your typical studio rooms or student accommodation. So I'd be a bit cautious on that and supply of student accommodation in cities. For me right now, the best bet is residential property. Make sure there's a good leasehold term on it. Make sure the ground rents are stacking up at 0.1 to 0.2%, so you're not going to have problems with mortgages. You know, make sure that you're buying in a sustainable development with a developer who has a good financial track record and a good track record of delivery. So that's my thoughts on the Northwest and Preston. Matt, did you have any other thoughts on Preston? I know you and Steve, my business partner, you've got property in Blackpool in the north, and Preston, obviously, you guys are quite excited about. So yeah, if you want to just say a few words there.
Absolutely, yeah. So you rightly say that I actually know this area really well. I actually lived not too far away in a place called Liverpool for about 4 years. So yeah, basically know Preston very well, and it's had a lot of money being thrown at it over the last few years, and is still happening to carry on with that regeneration. I think, like you touched on just there, Dale. So yeah, this is something I'm really excited about in Preston, because it's got a longer cycle to go than your likes of your Manchester and Liverpool. Okay, great places to invest, and absolutely something that I would look at in a balanced portfolio. But Preston is a very good one, because the price per square foot you're looking at in Preston is you know, is a lot cheaper, and it has some much more room to growth. And you know, it's only going to be a matter of time before that does follow in the footsteps of the likes of Liverpool and Manchester. And the HS2, like you touched upon, Dale, I think is going to no doubt help that. I think, just to add, it's where you say the transport hub, it's a really good proposition for businesses to situate themselves there, because if you can imagine, you know, you've got businesses that want to be in Manchester or Liverpool, the rents and the rates are going to be so much higher than you would be looking at if you was in Preston. Now, Preston being the transport hub, you can be into these major cities very quickly. So directors can jump on trains and be there. So it's also a very good thing for business growth. And that's obviously going to help the economy and help prices to grow and employment rise. I think you're on mute, Dale.
I agree, yeah. And I've had a few people mention, a lot of people coming in asking about what we think of Nottingham, Bristol. There's questions on Croydon. In fact, I invested in Croydon when I mentioned commuter belt. I think Croydon Central is probably quite expensive now, but there's areas around Croydon like Sanderstead, Purley, where you can still get good value for money. I think Nottingham's on our map at the moment. We're looking at some projects there. So again, maybe not right in the city centre, but slightly further out of the city centre. I think there's some good value to be had there. But yeah, there's lots of different areas. We just tend to keep an eye on the market, do a lot of market research, and then we will tend to then start to invest time into researching the areas. Like I said, tertiary areas are on the map, and it's certainly an areas that we are focusing on it at the moment. But naturally, places like Liverpool City, you can still get a really good rental yield, and Salford Quays, we just think there's a lot of regeneration. It's more affordable, it's a quick commute. So yeah, I can carry on forever and a day, but we'll get on to questions with Lynn, and then do some Q&As with the audience.
Wow, guys, I'm just picking my jaw up off the floor here, as always, because, you know, you both give such extreme, informative, massive value. And honestly, on behalf of everyone, thank you very, very much. I know you've given way more than we kind of expected on the run through. But that's the thing with Fabric, you know, they always give their absolute all. So thank you for that. So just a quick one to anyone who joined partway through. I was allowing a lot of you to come in. Absolutely no worries at all. Just a reminder that you will receive the recording via the emails or via emails, so you'll be able to watch it back. And I absolutely urge you to, because there's some huge information that's been given there by Dale and Matt. So just before we go into the Q&A, I just want to say I really would like to invite you all to stay on. If you have any questions, please do add them to the chat. We've got several in already. I've got absolute ton of them as well that have been sent to me directly. So we will try and get through all of them. If we do run out of time, because I think we're keen to keep this to an hour and a half, then don't worry, because we will get back to you afterwards. And just a reminder that by staying on to the very end, you will have access to the free gift at the end of the Q&A. So certainly urge you all to stay on. There's always benefits to listening to other people's questions. So I think we'll get started. So I'm going to go straight to the top here. So first of all, what kind of mortgage finance interest rates are available to international investors?
Okay, who you posing that to, Lynn?
Well, probably to you, Matt, actually. I was
Okay.
hoping that people would help me out, but Matt Dale, but it looks like I'm in this on my own.
You're the chooser. Okay,
Yeah.
fine, cool. Right, so it very much depends. I would say that the majority of our clients that are buying from overseas would buy in a limited company, and it is natural to say that, you know, as you're an overseas individual, you're going to attract higher interest rates than somebody who's here in the UK. So that's the sort of precursor to it. Now, what we usually say to clients who are investing is that if you were to buy cash to start with, if you're able to, then refinance, you've already got a footprint here in the UK. And in some circumstances, you can actually get better access to better interest rates and loan to values by doing it that way. But the typical sort of interest rates that you can see for an overseas investor is, say, 4 to 4.5%. You know, if you have that in comparison to a UK investor, that could be in and around the 3.5% mark. So, you know, if that's what you're doing for a limited company, that's the sort of, interest rates you're looking at. I know some of you may be thinking, well, you know, on moneysupermarket.com, I can see there's 1.something% or whatever else, but you've got to remember, this is investment, this is buy to let, not residential houses, for some that may be not as experienced in investing in property. So these are specialist in buy to let lenders that we're going to here. So to answer your question in short, 3.5% for UK is roughly where you're at, and 4 to 4.5 for overseas is, you know, is around the ball mark.
Perfect. Thank you, Matt. Thank you, Guy, for the question as well. Charla, and I will just say I'm very impressed with myself at knowing how to pronounce Charla's name there. That's because I had a one-to-one with her a couple of days ago. So, Charla, thank you for your question. You're asking about taxes that the investors are responsible for and how much are the taxes. Matt, do you want to carry on there?
Yeah, sure. So essentially, one thing I have to say is we're not tax advisors, although Lynn kindly told you all about 10 years ago that I was an accountant. But essentially, we have the professionals that can help with this. But I will tell you, you know, what it is. So it's very different depending on your circumstances. So depending on the income you've already got. If we're taking it from a limited company point of view, you have a 19% obviously corporation tax on that income, but of course you can deduct all of your taxable expenses away from your profit before you have to you know, take that tax.
Perfect, thank you. And Satya is asking, with low borrowing rates, is it advisable to go for longer term mortgages?
Who you
again, Matt, I'd say that's for you.
Oh yeah,
Matt's a qualified accountant, so I'll leave those ones with him.
I'm leaving the money ones with Matt here.
Yeah, no worries. Cool. So what was the question again? I lost the question there. What was it?
With low borrowing rates, is it advisable to go for longer term mortgages?
Right. So yes, this is one I talk to people a lot about. we are in unprecedented territory, and we are in low borrowing rates. So the answer is the interest rates really can go only one way. I know we're talking about an extended period. So if you would somebody that wants to know what your mortgage payment is on a monthly basis, and that's what you're paying, then look at a longer fix. But this comes all down to strategy, which is why, you know, it's so important to get to know each person's goals, because every single person on this call tonight may have a different strategy. And that's why it's so important to dive in, because what's right for somebody isn't necessarily right for somebody else. So, you know, if somebody's looking to get in and out of properties, then, you know, a long-term fix wouldn't be something for them. But someone who's looking to invest into property to create financial independence and wealth creation, you know, a longer term product would be probably more suitable.
Perfect, thank you. So Dale, I've got one here for you from Dintle. Dintle says, what key considerations would you say one would have to earmark when looking to buy international investment property, more especially during the pandemic climate?
Yeah, obviously things have changed, so you do really need to now do your due diligence online. You know, get on Zooms to discuss the projects, virtual viewings. So people have had to adapt really. Whereas we could just jump on a plane before and go see the sites and meet the developers and see the properties. You do need to take a much more measured approach. For international investors, I think it's important that you understand UK law. I think it's important that you understand the due diligence process in looking at investment property, in particular if it's new build and under construction. So do your research. Make sure you are dealing with experts in their field who are giving you sort of honest, ethical advice instead of just buying into the glitz and glamour, if that makes sense. So, you know, don't just buy something because someone's promising you a 10-year guarantee, or in most cases, it will be an assurance unless it's bonded. So we really like to look at product that's sustainable, that the market valuations are correct. Look at the price per square foot. So we use technology and software that calculates the price per square foot of the postcode, and then we can compare it to the other buildings in the area and make sure that you're paying the right price. Because the problem with international investors is developers will go overseas and they will sometimes sell at slightly inflated prices because the local market might not know the market as well. So again, don't just be bought into something because the brochure says you should, or you think it's a good investment. Speak to someone who can give you advice on location, price per square foot, rental demand, occupancy levels. Speak to some local agents, get on the phone and do your own research. You know, there's some tips we can give you that won't take up too much of your time, or we can help you with that process. So that would be my advice. And make sure you use a UK solicitor who is fully independent and a member of the UK Law Society, because they have become a lot more regulated recently. So they are now a lot more strict on off-plan, which is a good thing for the market, because it is meaning that investors are being protected more than before. That would be my advice. I don't know if Matt's got any others, but thanks for that.
Thank you. So thank you for that, Dintle. Justin is asking, Matt, do foreign investors need to pay tax for the property to buy?
Okay, so this is again comes back down to how the property is owned. So again, we're not tax advisors, but we can put you in right people. So if you own that property in a limited company, and then you take that income in that limited company and you go through a financial year leaving that profit in the company, then of course you will pay the tax, the same as a UK resident would pay the tax. Now, if you invoice that profit out of your company, then it will be the jurisdiction where you live that will determine the tax you pay. So that should answer your question for you.
Thank you. And we'll just stay with you here, Matt, for a moment.
Yep.
Which banks, building societies would you recommend to release capital from a wholly owned rental company? It's from Gillian.
Rental company. I'm assuming that's a
rental property. I beg your pardon.
Right.
That's my mistake.
Okay. No problem. So again, it's dependent on where that property is, and because different banks have different appetites in different areas, for example. So and generally, what you'll find is, you know, different areas of the country have different loan levels within banks. So like you said at the start, Lynn, I've had a lot of experience in this area. It's something I don't necessarily spend lots of time on now. I have specialist guys that I work with, but from my understanding from when I did it back then, you'll have maybe a loan book in a certain area, an exposure level, if you like, that will be at a certain level for some banks where they'll be out of the market and other banks will be in the market, and vice versa in other areas. So again, it's speaking to a specialist broker that's going to be able to look at the property you have, look at the rental that it's achieving, do the acid test in terms of the rental coverage. And if you don't know what that is, usually it's about 125% of rental cover or 140%, depending on the bank's criteria. Then that will determine what banks are interested and what loan you can get. So yeah, speak to a specialist is my advice.
That's great. And Gillian is also asking, I'm going to stay with you, Matt, here, because I know you've got a lot of experience on this. Do you think that commercial property is a good investment compared with residential?
Right. So the answer is it can be both. And again, it comes back to that golden bit of information I said earlier. It is very much about your strategy and where you are as an individual. If you're starting out as a property investor, I wouldn't advise you to go to commercial straight away. That would be completely unethical of me to say that. And the reason why that we talk about it is I talk about it in a very solid structure, like a wealth investment pyramid. And the reason why you do that is you build your solid base with your lower risk property first, and then you build on your layers of other types of property, which then bring the yield. So when we talk about city centre property, which we've spoken about this evening, I have to sort of jig how you think about it, because when city centre property, you're not buying for return, you're buying for safety. Now, when you look to layer in the rural areas, that's when you start to bring the return in, and you'll start the commercial property will generally produce a higher yield than you will in the city centre. So my advice is to, speak to a consultant, get your strategy set first, and then proceed, and you'll be able to say. But the answer is both can be good investments.
Thank you. Constantino would like to say hello to everyone. So hello back to you, Constantino. Thank you for that. Alan, we're going to stay with you here now, Matt, because Alan is asking, what are the UK stamp duty rates for buy-to-let property investments?
Right. So this is a topic that I'm I have a lot to say on this one, so sorry if this answer is quite long, but right. So very simply put, the rates in the UK at the moment for first-time buyers is 0% up to 500k. But obviously, most people in this call would be looking at this from a point of view of second property. So essentially, that is 3% up to 125,000 with a minimum threshold of 40k. Then from 125k to 250, it's 5%. Forgive me here for reading this off the government website, but above that, you've got over 575 to 925 is 10%. And then the remaining above is 12%. Now, the reason why I'm massively sort of have a big thing to say on this is because this tax is kind of a heavily weighted tax. Now, one thing that we need to do in this country is stop being a country of consumers. And I'm talking a bit more of the economics of this now, but realistically, the smartest minds in our economy are the people that have, the biggest wealth in our economy. Essentially, they've got the biggest businesses and they've got the biggest sort of revenue streams to the economy, bringing our GDP up, right? So to thrive as an economy in the UK, we need our GDP to be as high as possible. So that means we want to incentivize all of our smartest minds to live in this country. Now, by having such a high tax rate of stamp duty in this country, we're actually probably encouraging people to not live in this country. I know so many people, successful businessmen that have moved to Dubai and places like that because the tax structure and law system suits them better. So for me, stamp duty needs to be looked at, very closely, and actually probably made more of a fairer tax for all than, you know, trying to actually, you know, probably impose that on the welfare of this society. But don't get me wrong, I'm not saying tax is a bad thing. Tax is a good thing if it's spent and invested correctly by the government on stuff like, you know, transport links, which, you know, stuff like the HS2, which we touched upon in this webinar, and things like that. But it needs to be spent in the right areas so that we thrive as an economy and not sort of push our sort of, you know, biggest producers away. So sorry, it's a long answer, but that was the answer to that question.
Perfect, thank you. And staying with you, Matt, a lot of money questions here tonight, as you would expect.
Yeah.
So historically, Sonia is saying, historically, at what point did investing in property become so viable and profitable? And why was this? Is property investment here to stay?
Right, good question. So essentially, now it's probably around the turn of the century, sort of, you know, early 2000s, you know, probably late 90s, that sort of area, because the catalyst for it was actually the bank's appetite for buy-to-let investment loans. So, you know, it became a lot more, you know, affordable and accessible to the wider public, because since, you know, before then wasn't really classed as a, you know, as an asset class really in terms of an investment. But yes, so it's not had, you know, necessarily long time in the buy-to-let investment world, but property has got a long history, you know, coming back from 1952. If you download the Halifax price index report, which you can get online, and it's very easy to access, you'll see the trend that properties had over that time frame. So it's always essentially increased in price, albeit, like I said earlier, had a couple of corrections along the way, but it's always had cycles of growth which have continued to go for that, and that will continue as long as our population is growing faster than the amount of houses we can provide.
Absolutely. I will just bring you guys to notice about the time here. We did say we'd stick to an hour and a half. You know, just to let everyone know, the reason we do that is because obviously we're offering gifts as well at the end. We're aware of taking people's time out in the evening. You're investing time in this as well. So we don't want to keep you too long. We want to be able to get to the end, but we will certainly get back to you all with your questions. And there's a lot coming through here. So just a couple more, then I think we'll go into. So Wale is saying hi to Dale, and I think Dale is saying hi back. So hi to you, Wale. CG is saying opening an account in the UK as a foreign investor is a major challenge. How can one overcome this challenge to get in the market to purchase?
Dal, do you want to talk about our partners over?
Yeah, what I was going to say, guys, because we're getting quite a lot of questions on sort of the finance side and tax. So we actually partner with mortgage professionals who have access to all the lenders in the market for UK and overseas buyers. But we also partner with the likes of a company called GetGround. Now, they are a new tech startup. I say new, they've been going a couple of years, but what that's done, it's made it 10 times cheaper to set up a UK limited company. They set up a UK bank account for you. And there's also benefits on, you know, reducing your tax liabilities in terms of inheritance tax and so forth. So that's one way to do it, because one challenge I've always had is from overseas buyers opening a UK account. So we do partner with people such as GetGround, you can literally set up a limited company within a few minutes online. They guide you through the process. It's a whole separate presentation and webinar, so we'll probably cover that on one of the up and coming webinars, and we'll get GetGround and our tax experts on there, and then they can obviously answer those questions, because they, you know, obviously from an FCA regulated point of view, they'll be able to give you professional advice. But so the answer to your question is yes, you can set up a account. It can be quite difficult, but we found a solution with some of our partners, GetGround, so you can check out their website, and we're glad to get you on a call with them and they can give you some further advice.
Perfect, thank you. So I am going to stop the questions now. Apologies to everyone, but you will get an answer. And I think some of them actually Dale has tried to answer along the way together with Matt. So just moving on here, I think, you know, Matt, we were speaking earlier on today about giving away a free gift. Would you like to tell everyone what this is, please?
Yeah, absolutely. And thanks for everyone for sticking around to the end. So the free gifts that we're going to give away, we're actually going to give away 2 free gifts. So lucky
What?
you,
What?
lucky you guys.
They keep all the good information away from me, people.
Yeah, absolutely. So the first one is our Manchester investment guide, and this is going to give you all of the information you need to know about investing in Manchester. And if you're interested in that, this is going to be a very helpful tool for you. It's going to go over some of the stuff that Dal mentioned, but it's going to go into a lot more detail. So that's number 1. But then you've got the golden free gift that we're giving away tonight, which is a free strategy consultation with a property consultant. Now, the value of this is I can't put it into words how important to have a strategy is. If you can imagine enthusiastically running away from your goal, that could be the danger you're putting yourself in without the correct strategy that will actually allow you to hit your goal. So in that strategy session, we'll talk about your goals. We'll help you to look at a strategy that's going to help you to hit your goals and get you on the right path. So yeah, hopefully you get lots of value from that and utilize it to its best.
Perfect. Wow. I know, Matt, you spend many an hour doing these personal consultations along with the rest of the team. So that is a huge thing to give away there. Takes a lot of, time for you as well to look into the areas that you spoke of earlier about people's finances. So what I'm going to do now, guys, if you can just get ready to put into the chat, what I suggest you do is, if you would like to have the Manchester investment guide, then please put Manchester in the chat now and we will get that across to you. If you would like the strategy session with one of our property consultants, please put strategy in the chat now. And if you'd actually like both of these free gifts, that's 2 of them, please put bundle. Bundle is a good word to use in the chat now. So I can see you're all probably thought I'd stop at Manchester, and now suddenly everyone's going mad on the bundle. So we will fulfill that wish for all of you. Please do keep them coming in. So if you've got any questions at all, other than the ones that you've put in there tonight, please do feel free to contact your dedicated property consultant at Fabric, and we will get those answered for you. Each one of us has in excess of 10 years experience in the property industry, and we'll be more than happy to jump on a call or a Zoom with you. So Dale and Matt, on behalf of everyone here, I know this goes without saying, but a huge, huge thank you for your time and valuable knowledge this evening. You always over-deliver each and every time, and I promise you it's very much appreciated indeed. So thank you all again for everyone for being with us today. It's truly, truly appreciated. We'll be back with you again soon. Keep your eye on the emails for the next webinar. Stay safe, stay well, and look forward to seeing you soon. Take care.
Thanks. Thank you, Lynn. Thank you, everybody. Have a great evening. We'll see you soon. And yeah, get in touch with any further questions you have. Take care.
Thank you.
Bye-bye.